Welcome to the HC Insider Podcast. I'm Paul Chapman. Today, we're joined by Roy Salame. Roy has recently retired from JP Morgan's private bank, where he was the managing director and global head of the Investment Opportunities Group. Prior to that, he had an illustrious career in commodities, both with Goldman Sachs and JP Morgan. At JP Morgan, he was vice chairman of global commodities and also global head of sales and structuring. Today, we're here to talk about commodities for investors. Why should investors think about commodities, and what are the various pros and cons around the instruments they can invest in? And also, what's the forward outlook for commodities as a sector? Roy, thanks for joining us.
Good morning, Paul. Thanks very much for having me.
So I guess we're here to talk about commodities for investors, commodities as an asset class. I want to start off by asking, why should investors around the world care about commodities?
That's a great question. Maybe I think we can start by talking about, the debate that has raged on for years. Commodities as an asset class, is it truly an asset class or is it not? Does it qualify? Does it have the prerequisite kind of profile to really be described as an asset class? And I think that debate has really been settled, and it is indeed perceived by many institutional investors and other market participants as indeed an asset class, and has occupied this space for now a number of years as it has matured. Commodities, though, for me, more so than the debate around asset class and its role in the portfolio, and we'll spend a few minutes on that afterwards, is really, in my mind, the macro of all macros. And the reason why I say this, when we think of foreign exchange and the interconnectivity of global value of currencies and their impact on trade and purchasing power as driver of global economic activity, commodities in many respects actually occupies a similar, if not bigger role. When you think of all the different sub-asset classes in that macro asset class, from industrial metals to obviously energy, all of these elements are really at the core of what makes the world go round. And for me, thinking about commodities and thinking about exposure to commodities and thinking about commodities as an asset class starts by understanding the fundamentals of commodities in order for you to be able to understand the macroeconomic outlook and what is going on in terms of trends, emerging trends, or sunsetting trends in a global macroeconomic perspective. And that, for me, is probably dwarfs the whole discussion of, is commodities from a financial perspective an asset class or not? Because at the end of the day, when you think of commodities in terms of its overall size from a financial perspective and the global exposure to commodities in the financial markets, it's really de minimis by comparison to other financials like equities and fixed income. It's not even 0.1% in terms of overall notional dollar exposure. But the importance of commodities to the macroeconomic landscape and global trends in economic cycles is absolutely vital. And for me, that's the most important aspect, and why people should pay attention and focus on commodities and have an understanding of what is going on in the commodity space.
What should investors therefore just be reading about commodities, or is there something they get by actually investing in commodities that, I guess, provides more insight and more, I guess, forward-looking data to understand the broader macroeconomics going on?
I would say both. Being educated and have an understanding of commodity cycles and what is going on in the physical markets at a high level is very important to forming an understanding and a view. As far as investing in commodities, is there a benefit? For sure. Expressing a view or taking a view on macroeconomic activity and the cycles that we're in, and expressing that view in addition to expressing it through equities or fixed income from an interest rate perspective, or currencies for that matter, expressing it through commodities can be quite rewarding, while obviously representing significant risk given its volatility. It kind of ranks in the same level of volatility as equities, and at times even more volatile than equities. So in terms of risk reward, you're going to think of commodity price risk exposure the way you think about equities. And from that perspective, clearly expressing a view, a bullish or bearish, through a commodity, particularly in the energy space or in the industrial metal space, like copper, which kind of, in many respects, is a barometer. Industrial demand is actually quite valuable and could be very rewarding if done right.
I was going to ask my two other questions on this particular segment are, firstly, are there certain commodities that are better at providing that kind of leading indicator information? And I know you were involved in the early, instrumental in the Goldman Sachs Commodity Index, one of the early commodity indexes. Is there data out there? Is there actual evidence that that we see it as a leading indicator?
The first part of your question, are there specific commodities that are kind of leading indicators? For me, in the industrial metal space, I would consider copper to be the king of that particular segment. I would consider crude oil and Brent more so than WTI as being the barometer from a global energy perspective. And when natural gas ultimately become, in terms of its price discovery, a global commodity, like the evolution that we saw in oil, the minute we started kind of transacting and moving oil on super tankers around the world and creating a global oil market, which hasn't yet happened, although we're on our way to developing a global natural gas market with the growth in LNG in all parts of the world. Eventually, we will have a global natural gas market and a global price discovery and a global benchmark. Right now, we have regional benchmarks for natural gas, and ultimately, that global price for natural gas will also be at par with Brent as a global benchmark for crude, and as far as metals are concerned, copper. So for me, these are the three kind of leading indicators for ultimately getting a pulse, so to speak, on supply and demand fundamentals in commodities. I would add to that mix gold, although it is not a classic commodity per se. It is a financial asset. It's a commodity. It's an industrial metal in some respects, together with silver, obviously, which has even more of an industrial overtone to its usage. But gold plays an important role and is an important signal in terms of inflationary pressures building out and the views of investors and central banks and monetary authorities in terms of the inclusivity of gold as part of the reserves. And accumulation and increased accumulation of gold, like we have seen over the past several years by central banks, is a leading indicator of a concern about potential inflationary pressures down the road. And particularly in a zero to negative interest rate environment like the one we're in at the moment and have been in for quite some time, particularly now the United States having basically set a policy of zero interest rate for the foreseeable future, gold has taken on an importance. And because of the fact that dollar rates are at zero, there is little negative drag about including gold in a portfolio because you're not losing much on or losing anything on the fact that gold is not yielding positive returns in terms of holding it as an asset, and you can afford to hold it and hope for the protection it affords you in an inflationary environment. We've seen that uptick in price obviously reflect that investor sentiment towards that metal. So for me, all of these four really are the principal kind of pillars of the asset class. Is there evidence of the GSCI, let's say, of that index was an important catalyst behind the whole establishment of commodities as an asset class, the formalization of the view that commodities deserve a role in a portfolio as part of an asset class mix in a diversified portfolio. And the premise behind it was because of the fact that commodity prices tend to be negatively correlated to financials, they tend to rise in a rising interest rate environment where financials tend to do poorly in a rising interest rate environment. They tend to, when put together with financials at a reasonable percentage, say somewhere between 3 and 5% of a portfolio construction, they tend to reduce overall volatility of returns and improve overall returns. So because of this negative correlation to financial. So that was the premise behind creating the commodity index. And then subsequently, there were other indices that were established to give you an exposure to the asset class without you having to take a specific position or a view on a particular underlying sub-asset class like energy or industrial metals or precious metals. So they're all part of those indices. And a number of institutional market participants have traditionally used these indices to diversify and take advantage of this negative correlation as part of their asset mix.
Yeah, and I want to carry on talk a bit more about indexes in a moment because obviously they've come into under some fire depending on how they're actually constructed recently as well, with obviously the negative oil prices and theories around index funds having a role to play in that. Before we move on to that, just that debate around commodities as an asset class, does that ultimately stem from the fact that unlike equities, bonds and so forth, there's no actual, they don't generate an income, there's no free cash flow that come off them in the form of coupons or dividends?
To some extent, yes, Paul, although obviously the construction, if you think of the GSCI as a perfect example and the roll yield, the GSCI from a total return perspective is made up of, the spot return associated with price increases or decreases of the underlying commodities that are part of the index. And is also this roll yield associated with rolling the first nearby contract second into first continuously as time passes and that contract comes to maturity. These futures contracts come to maturity. These by themselves, these roll yields provide a return in addition to obviously the return associated with the underlying treasuries. So there are three components that mimic a little bit a it's not a coupon, it's not a dividend, but there are other aspects aside from absolute price appreciation or depreciation of the underlying commodity that may generate returns and complement the returns, particularly if you are in a backwardated curve structure, which obviously represents a positive roll yield because you're basically buying every time a second nearby that is at a discount to the first nearby, you're selling it at a higher price than what you bought it at. And by default, that provides you a positive roll yield to complement, if the price of the underlying commodity has gone up, this is incremental return to the price appreciation, capital appreciation. That's the best way I can try to kind of mimic a little bit a dividend or a coupon for you, aside from the actual appreciation or depreciation of the underlying asset.
Yeah, there are index funds out there as well, though, that actually hold the asset itself and warehouse it, which itself brings risks or costs, that aren't present in holding an equity.
Sure, absolutely. The ETFs are holders of the underlying commodities by default. They're holders of the actual contract or holders of the metal, like gold ETFs. So and they incur storage costs and or incur vaulting costs, etc. But so for sure, ETFs that have come about definitely hold the underlying asset through these contracts, through futures contracts, which obviously, like in the case of the USO, we saw these are actual contracts that would come up for delivery if they were not liquidated prior to entering into that delivery cycle. If held on through that expiry, will ultimately result in a physical delivery of crude oil.
This has a role in portfolio theory. You mentioned about it beyond just generating insight and being a leading indicator, it also has some benefits about not being correlated with other potential market events, protection against inflation and so forth.
I would caveat this only with the following statement, that when there is a general risk on or risk off sentiment in the market, like we saw during the global financial crisis, or like we saw earlier this year at the onset of the COVID pandemic in mid-March, that negative correlation breaks down, because in a risk off sentiment, there is nowhere to hide. The capital is literally liquidating across the board and taking risk off the table, and commodities are not an exception in this case.
With, as I think we've seen, with the possible exception of gold, where you've obviously seen gold prices rise quite dramatically.
Yes,
during
that's a
this
flight to
pandemic.
safety. Yeah, yeah, yeah.
Yeah. You've sat in this exact seat. You're sat opposite, some of the wealthiest families, institutions talking about investment opportunities. It sounds like there's a compelling reason why you should have some exposure to commodities. And I think, as we've already alluded to, there's a whole slew of different pathways to do that. Can you walk us through some of what those pathways are? How would you advise your client to actually get exposure to commodities?
You're absolutely right, Paul. There is now a broad spectrum of different ways of gaining exposure to commodities through exposure directly to the underlying, either through futures contracts or through ETFs that have a direct exposure to the underlying and track an underlying commodity specifically. There is obviously exposure to the underlying equities that have whose principal business is the underlying commodity. In my view, though, the purest way to express and gain exposure, if you have a view on the underlying commodity and want to participate in that market to complement a view on, the broader macroeconomic cycle, I would personally opt for either to facilitate the investment through a specific ETF that is tracking a particular commodity, such as a gold ETF or an oil ETF, or if you want to have a view on a particular sector like the E&P sector, there are ETFs that track and have a basket of underlying E&P companies, exploration and production companies, as what they track in their underlying equity basket. And then you can gain an exposure to that particular segment by being long that particular ETF. Now, I would stay away from inverse ETFs, which is a way of shorting a particular segment or a particular commodity. These are highly dangerous, and particularly levered inverse ETFs are incredibly volatile, and I would stay away. If one has a bearish view on an underlying commodity, then I would express it through an option strategy by being long a put option on a particular underlying commodity because I'm bearish, and leave it at that.
It's interesting. So ETFs to get exposure to directly to the commodity. If you're looking at more sort of a regional approach, there's ETFs out there. Obviously, over the last 20 years, and we discussed on this podcast whether it's actually been a successful strategy. There's been a number of commodity focused funds. What's your view on investing in hedge funds in commodities? Any take there? Now that you're out the industry and you can perhaps be a bit more open about that.
Well, some of them have done quite well, and a number of them have closed shop. It's been a very difficult market to trade in the past several years. The pie has shrunk quite dramatically in the asset class, broadly speaking, and the returns have been much more challenging over the past several years, although 2019 and 2020 are both proving to be much more lucrative years, again, from a commodity trading perspective, because the recent volatility in prices has brought about a more conducive environment. But prior to that, these markets had been very challenging. And as a result, we saw a number of commodity focused hedge funds really return capital back to their investors and close shop. And returns had been quite disappointing. So a quant have not been as active in the commodity space as we have seen them really in other asset classes, in the financials in particular, although they have started to develop of late. And we've seen recently returns from the likes of, some of the largest players like Millennium, etc., deliver quite significant positive returns in this asset class, which is quite encouraging.
So I guess changing gears, we're now, dare I say it, approaching 2021. Can't believe it's September already and feels more like March 72nd or something like that, given the year that we've had. But as you look forward, how would you be advised? We're going through a time of significant change in the commodities world. It's under pressure from energy transition, both the twin forces of globalization, but also sort of balkanization of trading partners. What would you be advising if you could start, a client fresh today, their commodities exposure? What trends would you be thinking about, and how would you gain exposure to them?
First thing I would caution about the fact that while we are indeed in a transition, particularly in an energy transition, which has been accelerated, obviously, with climate change gaining more momentum and the science behind climate change gaining greater respectability, particularly post-COVID. And I think that's been a very important development of this phase that we have experienced over the past several months. Um, I want to caution that this will take several decades to actually materialize. The progression and the transition will be slow, and it is not a switch, and it is not something that investors can position for and look for short-term or even medium-term gains that are substantial in nature, um, with the exception of a few plays, and obviously that the cat is out of the bag in some respect, the likes of Tesla. That trend is definitely in motion. It is visible. If you look at the International Energy Agency, aside from COVID, the decline post-COVID recovery, the decline, progressive decline in hydrocarbon consumption is definitely part of their forecast for 5 years out and 10 years out. You see those declines in their forecasts, but they're very gradual. As we reduce our consumption of oil-based hydrocarbons, I think natural gas is going to play an important role as a transition fuel that has obviously a lesser greenhouse gas impact, 50% less than oil, which is obviously very important and continues to play an important role in backstopping intermittent renewables like solar and wind in the absence of wholesale battery, kind of a power storage capacity that could really help the intermittent nature of solar and wind um, to be self sustaining without the need for a backup generation, gas fired backup power generation. We need significantly more advances into wholesale power storage, which is happening. The costs continue to decline, but that comes with its own environmental baggage, so to speak, because all of the components of these super batteries are quite toxic in their own right, and disposal of these and recycling of these is an environmental liability that has yet to be grasped by the general public. So there is a dark side to renewable that has to be taken into consideration, so to speak, from a greenhouse perspective, an environmental perspective that has to be accounted for and has to be dealt with, particularly as we scale up into renewables and scale up particularly into wholesale battery power storage. So I would caution around positioning for this transition aggressively to the short side against hydrocarbons and to the long side against renewables, because that's a recipe for pain, in my opinion. One has to be gradualistic in their approach, measured and tactical. For instance, I really think while I am, somewhat bearish to neutral in the front end of oil at the moment, I do believe that, 2 or 3 years out, as a result of the very dramatic capex reduction that we have experienced over the past year in particular, we're going to see this bottleneck emerge a supply shortage in 2, 3, 4 years' time on the back of sustained, albeit slightly weaker demand, but strong demand nonetheless. We're going to see tightness in the markets that is going to weigh on markets and prices, which is the only way to force these markets back into equilibrium when supply and demand are out of balance, are expected, in my opinion, to firm up in that medium term. So I'm constructive energy. I'm constructive oil prices, where I would see Brent going back into the mid 60s to mid 70s. 2 or 3 years out because of this supply demand tightness. But I'm not particularly constructive in the front end. So while overall I am of the view that the energy transition is accelerating, there is still, a bullish outlook, medium term that can be capitalized on, and one should not ignore. You see what I mean? So that's what I refer to by being tactical in one's view and measured in one's positioning to take advantage of these short to medium term developments that are going to be quite important as we continue through this transition.
On the strategic side, and I'm going to get my investment accounts ready. There is a clear path of energy transition. There is this, you see this increasing demand for batteries, et cetera, et cetera. Are there new commodities that you would be advising clients to start to take positions in, whether it's, there might not be the ETFs available, but through equities, that you think will become more dominant and therefore increase in value over the next 20 years?
Yeah, there's been a lot of focus on, cobalt, and a lot of focus on rare earth, a lot of focus on lithium. There are obviously companies that are prominent producers of all of these. Some of them are not traded on the public market. Some are, particularly in the lithium producers. There are some publicly traded companies that one can position in. But there's been tremendous volatility in these equities. I think it's, again, a bit too early to really kind of make a decisive play on. And people have looked at this, Paul. If I wanted to express a view on renewables, do I want to look at the end product? Do I want to look at the components that go into making this end product? Do I want to look at an electric vehicle, or do I want to take an exposure to the semiconductors that the usage in an electric vehicle of semiconductors is going to be significantly higher? Do I want to take a look at all of the advances taking place around 5G, which are going to be incredibly important to autonomous vehicle, which is going to be very much part of the electric vehicle kind of, and you saw that in Tesla, you're seeing that in the new generation, let's say, of the S-Class Mercedes that are they're launching right now, the hybrid and the EV, which is coming out next year. They're quasi-autonomous. All of these are coming hand in hand. And do you want to take a view on, how do you take advantage of that versus do you get long, Tesla, or you get long, a Baidu, or you get long, an electric vehicle company in China, etc. Those are continuous debates, and it's really a matter of liquidity, a matter of depth of market to be able to really position in relevant size, to be able to make the investment kind of relevant. And that's been the challenge. We saw some significant positioning in lithium, and we saw some significant volatility and disappointment a couple of years ago as people tried to kind of take advantage of the dramatic increase in electric vehicle production in China, particularly when it became one of the Chinese government kind of strategic initiatives with significant support and backing, and prices skyrocketed and proceeded to come off sharply. So it left a lot of investors kind of a bit disappointed by all of that. But again, the trend is returning, and I think there are merits, but again within reason, to position for the underlying component of either batteries or electric vehicles or versus the finished product. or the companies themselves, the equities that are driving that particular development forward on an accelerated basis. Same goes for wind, same goes for solar. There are a number of ETFs that are dedicated to renewables and dedicated to solar that have been quite popular. And there are similarly wind. There are a number of vehicles that have come on that have been quite successful in really kind of honing in and allowing an investor to express a particular view on that sector. My view is to look carefully at the universe of investments available and look at the liquidity afforded to an investor in each one of those instances and make a decision if you want to express the view through the component or through the end product or through the underlying equity if that equity is traded publicly and or through an ETF that creates a basket of a number of these equities and companies that could afford you an element of diversification to a particular sector that you have a view on. So that would be the progression in my mind.
It's fascinating. It strikes me that I guess by focusing on the underlying commodity, you can avoid some of that political uncertainties that surround energy transition in particular, whether you've got governments that are accelerating it or not. I guess it removes some of that noise. Is that a fair statement?
Sure, it does. And usually, like in all cases, particularly in commodities, the purest way to express a view is through the underlying as opposed to being long or short a particular equity because you're introducing noise into that investment that is not necessarily related to the underlying. So you're bringing in management, you're bringing in decision making and corporate decision making that is not necessarily um, in line with the underlying commodity and its price cycle. So you're bringing in exogenous elements to that investments that are unrelated to the underlying that introduce noise into that investment. That if you can avoid it, unless you're excited about the underlying commodity, the underlying company itself and its strategy and its management, where it's heading, and et cetera, then the purest way to really kind of gain that exposure is through the underlying itself, and that applies across whether it's renewables or otherwise.
Final question, and I guess changing tack slightly. Cryptocurrencies have been allied to commodities, even within institutions as well. It seems like some of the management teams from commodities have moved into cryptocurrencies, or at least that's fallen within their purview. What are your thoughts there for investors? Does that share some of the similar attributes? Is it something that you would consider a part of a portfolio?
I mean, look, a lot of people kind of equate the development of cryptocurrencies to the early days of the development of commodities from a financial perspective. Yes, there are definitely elements to that. There are definitely, which is why a number of commodity traders have made the transition, particularly during the lean years in commodity trading that we were just talking about earlier in our conversation when returns were not that attractive. A number of commodity traders migrated to cryptocurrency trading. And there are definitely similarities in the way these markets have evolved. And having said that, I really don't equate. I mean, yeah, a number of people have made the analogy of cryptocurrencies as a store of value. I don't subscribe to that view. It doesn't have the breadth, scope, and established goal and value that gold has. Gold's perceived value as an asset that is no one's liability and has an intrinsic value built into it. But Bitcoin aspires to be that store of value and no third party's liability, which in principle, it does have the profile by construction, but in terms of acceptance, is very far from that still. So for me, to kind of equate these at that level to say it's a store of value just like gold, I think that's where the argument falls apart. There are definite similarities in the way these are progressing between cryptocurrencies and commodities from a financial perspective. and their acceptance as an institutional marketplace with transparency and price discovery that gives institutional market participants the comfort that they are trading in a market that is regulated and transparent, which is not the case yet. There are participants that are starting to make an effort to institutionalize cryptocurrency trading, but it's very few yet that have achieved that, and it will take time.
Well, it's been a fascinating discussion, Roy, and I think actually brings to the front kind of my passion for commodities is really because it is at the center of global macroeconomics, global policies, global trade. In the end, I think, as you highlighted right at the very start, if you're interested and follow and have an exposure to global markets, then some knowledge of commodities is really important to inform your views. And I really appreciate you coming on and talking not only about, I guess, commodities and why we should care about them, but also, if you have the interest, how you should go about thinking about investing in them.
Yeah, I appreciate it, Paul. And for me, one additional dimension, beside all the ones you mentioned, which I completely agree with, is the geopolitics, the global geopolitics of commodities, and the interconnectivity of that is absolutely fascinating. I mean, if you think about one of the evolution we didn't touch on the call, we talked about renewables and we talked about the transition from the industrial into which is hydrocarbon based and hydrocarbon intensive, the industrial age, to this new age we're entering into, and the challenge that climate change is posing, and the need to transition to less carbon intensive energy sources is really even the stress around food security and water, and these are global trends that have yet to really kind of become or rise to the forefront of investors' kind of psychology when they look at global emerging trends. Food security is going to become a very important issue as arable land becomes ever more scarce, and global population continues to rise rapidly. And scarcity of water, we're depleting our water resources and sweetwater aquifers at unbelievable rates. And soon the only alternative left is going to be desalination of ocean water. And the amount of energy demand that comes hand in hand with desalination is enormous. The implications of that are huge. And the geopolitics of water will become the focal point, just like oil was in the 20th century, and drove wars and geopolitics at an absolutely existential level. The fight for reserves and positioning for control of oil, water will be the feature of the 21st and the 22nd century and beyond. And access to water and the ability to control water supply is going to become the absolute new focal point of global geopolitics. So for me, that's a commodity that has yet to be kind of part of the equation and to be discussed and evaluated in its own right as absolutely central. We can avoid to take a car, we can avoid to fly, we can avoid to do all sorts of things, but we can't live without water. It's that simple. It's that existential. As much as we thought oil was essential to life and growth and development, water is at an even higher level of existential threat. That's part of why commodities are so fascinating for me as well.
And we're already seeing that in the Middle East, right? There's very, very limited international treaties and I guess enforcement of around being downstream
very much so
of other countries. And as you say, oil might cause an economic or a political spat. Water is a whole different scale, right?
Absolutely.
Fascinating to have you on, Roy. We really appreciate your time. It's been a really interesting discussion. And again, I think highlights another just how interesting this sector is. So thank you very much. And, I hope we can connect again soon and continue the discussion on another episode.
Thank you, Paul. I appreciate the opportunity. All the best.
Thank you for listening to the HC Insider podcast. To find out more about HC, go to hcinsider.global, where there's more news and content focused on the commodities markets.